But when you have illiquid markets and all of a sudden you have computers selling hundreds of thousands of shares of stock or futures, you have a problem. And of course the flash crash, which has brought about a hell of a lot of illiquidity. This is the Kuala Lumpur Stock Exchange, 1997. In the wisdom of the folks in Malaysia, they put a prohibition on short selling. You can't short sell in Malaysia. They thought that was a good thing. Well, when I went over to Malaysia and did talks in 1992, 1993, 1997, I had an opportunity to talk to these people. I said, look, when you don't allow any short selling, now I'm talking about legal short selling. I'm not talking about fraudulent short selling. And I had an opportunity to talk to these folks over there. I said, look, when the market falls, who in the hell is going to buy back in? You have no support because you have no short sellers. The only way short sellers can make money is to buy back in. You're in a situation of high danger. You know, and it was, see that exit sign? It was just like talking to the exit sign. They didn't get it. They didn't have any idea what I was trying. They're like Bernanke is today. And this is the result. When the things came apart in 1997, they didn't have a small break. They had a collapse. They lost all the market value because the markets were illiquid. Illiquid. Now, some of you know that I was one of two people back in 1987 that predicted a 500-point decline in one day in the markets. Many people over the years have asked me, how in hell did you do that? Was it luck? It's not luck, had nothing to do with it. But I normally wouldn't answer the question because I really didn't think that in my trading lifetime I would see a circumstance unfold that would make it useful for the client to really understand what my reasoning was for making that prediction. Now, I think it's pertinent, and I will explain to you how I made that prediction, and you will see how this relates to today's markets. In 1986, late 86, we had, for those of you that are Dinapoli traders, thrust, break below, break above, break below, double repenetration signal right there. We had a very substantial break in the market. We had a huge break in the market. I actually think it was the biggest drop in the Dow. It was 87 or 88 points to that point. And in the E-mini, there were absolutely no bids. In other words, anybody on the floor that tried to provide liquidity and tried to buy, they would buy, but there was nobody to sell to. So everybody that bought got killed. Everybody that sold, they didn't get filled until they got all the way down here at the bottom. Now, one thing about the traders in Chicago is they learn. They learn. And what they learned that day is to keep their hands in their pockets when this sort of a day happened. The next day, the market opened, fell some more. Well, we had a combined over a 6% fall. I called down at the floor because I had good enough connections to place my orders directly with the floor, and I said, what the hell's going on? It looks pretty brutal. And they said, Joe, you're not going to believe this. The market is totally devoid of bids. I said, really? Nothing? Nothing. They said, stay out. I said, okay, I'll stay out. I was already in short because of the double repenetration. But anyway, that's not the point. Point is that the market had absolutely no support. Now, I said to myself, okay, if the market has no support, what would happen if the market has a massive break someday? I went to a yearly chart and I did a series of Dinapoli levels, focus, reaction, 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 and I came up with a confluence area at approximately 1210. 1214 to 1210 was the confluence area. What I did was I took the close, 1767 after that day, subtracted it from where the confluence level would be, and determined that it would take 566 points in order for the Dow to reach the confluence level, which I was quite confident would support the market. That's how I came up with the 500-point decline. It was actually 566, but I thought that was a little bit on the excessive side, so I said just 500. Now, I had two reactions. One was laughter, the other was open mouths. Later, the market made a new high. When you make a new high, it brings up all of the Fibonacci levels, and the same confluence level, because the high from which it is measured is higher, the same confluence level came down here to 1712. So it moved up from the previous area up to approximately 1712. This is the 500-point decline right there. Happened in a single day, right down to the confluence level. The actual decline was 509 points. Why did it happen? It happened because of illiquidity. There was no liquidity to the markets. I knew once the floor traders learned to keep their hands in their pockets that the next time they saw the market coming apart, they weren't going to be buyers. They were not going to be liquidity providers. Now, let's look at the flash crash. If you look at the confluence level on a weekly chart, the confluence level created brought us right down to the level at which the flash crash stopped going down, supported, reversed, and went up. This is not an accident. Okay? This is not an accident. The reason that market supported was because it came right down to that confluence level. Now, could it have come down to the lower confluence level at 9,200, therefore sustaining an even more substantial drop? The answer is yes. The answer is yes. So instead of a 1,000-point drop, what do we have? 1,800, 1,500, very possible. Now, if you do some measurements on today's markets, here's what you get. Your major area of support comes in at an agreement level. That would be A, B, C, agreement down very near where the old low was, around 6,600. That's the COP. The next possibility down would be the 5,400 area, right? My pointer's not working anymore, right about there. And the area that is most likely, based on my experience, many years' experience working with these numbers, is 35, what is that, 35.29. So if we have another situation where the markets start to unravel, the most likely stopping point is 35.29. The next most likely would be 5,400, and the least likely, but still possible, would be taking out the old low or being in the vicinity of the old low. And it's not going to take, here's the point, it's not going to take a big news story. It can be a small news story which will be made big, because that's what they do. They fit the news to the market action. If you haven't figured that out, you're pretty much a beginner. But what they do is, let me stick with the point. The point is that it's not going to take a lot to get the ball rolling. If this thing breaks through some important levels and bashes out some of those bids, we could cascade down to the points that I'm showing you. All the ingredients are there, just like they were in 1987 for a market collapse. And if we have a market collapse, since they have these so-called circuit breakers in there, the form it will take will be closure of markets. In other words, they'll try the circuit breakers, they won't matter. They'll then open the market, boom, they'll go to the next circuit breaker. They'll open the market, go to the next circuit breaker, and they'll decide we better shut the markets down. And that is the potential of the Armageddon that I see. What are the chances of this happening? Well, I think I would rate the chances based on everything I see, based on the political situation of this country, is mind-boggling. nobody seems to be able to solve anything, and everybody's bought that goes to Washington. So what sense do we have? So I would assess the possibility. Washington. So I would assess the possibilities of this coming true to be somewhere around the 40 to 50% level. Now, there is a way that we could mitigate some of this. If the Federal Reserve is going to manipulate these markets up, which is exactly what they've done, then they need to have not just a plunge protection team, they need to have a surge protection team. They need to provide the liquidity that nobody else will because of the nature of the markets. Can we make money in these markets? The answer is yes. But as I said before, you need very, very good techniques. You need a lot of discipline. And you need to learn how to keep powder dry. 2 years ago, I would commit about 85% of my account. Now I rarely, well, I have a bunch of accounts, but in total, now I rarely commit more than about 30 to 35% of my account because of the excessive risk involved in these markets. You can still make money, you just can't make as much. If any of you are interested in learning how to trade the way I do, this is the book for you. Do we have any here? Patty? Do we have any books here? Did we bring any? Okay. If any of you aren't going to be here tomorrow, we brought a couple of books by in case you might want to buy them. If you are going to be here tomorrow, it's better you wait till then and come by booth 119 to get them. We brought them by for people who are leaving tonight. We have trading course available that teaches you about trading the way I do, and it also teaches you money management. We have a DVD that myself and one of my students, who is now a hedge fund manager, did. It's about 4.5 hours long. All this stuff has a reduced price if you buy it at the show. We are offering to anybody that wants it a forecast that we have for 1 month free. If you don't want to trade the way I do, if you have no interest in D-levels, there's no point in signing up for this D-level financial forecast. Not going to make any sense to you. You need to study the book. You need to have some idea about what's going on. Tomorrow we'll be at the booth 119. We've got 3 Dinapoli experts there, plus myself. To be a Dinapoli expert, it's a minimum of 8 or 9 years with me. So these guys are sharp.